Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 237th VideoCast podcast for the week ending May 2nd, 2024, live from Laguna Beach, California this week, out here for water polo tournament. Very excited about that. And quick photos, family updates, then we'll get right down to it. We have so much to cover in a short period of time. So this was the swimming banquet this year. Mimi, Annabelle, the whole crew, Caitlin, all looking great. So we had fun at that. And then this is from yesterday when we just got off the plane. We're down here in Laguna Beach. It's gorgeous. It was more so yesterday. We'll see about this afternoon. And then I want to thank Sean Calebs and Nancy Saeed Ali for having me on CGTN America last night to discuss the Fed. We're going to get to that really quickly. I did want to take a moment. Last week, I ran through a long list of clients, new and existing, that I wanted to thank and show my gratitude for. And one I wanted to point out that was written on another sheet of paper. Dale J has been with me for about a year now. And so if you are buying a car in the state of North Carolina, you're probably buying it from one of his dealerships. Big shout out. And if you are in North Carolina looking to buy a car, reach out to me and I'm going to connect you with Dale. I'm sure he'll hook you up with a great car, and it'll help Dale out and allow me to show my gratitude as well. But thanks to that great list and the support over the years, some of you months, some of you years, and many, many more great years to come. Okay, so we're going to tune into my take on the Fed yesterday and what that portends. So here we go.
Okay, with us now to talk all things Fed is our good friend Thomas Hayes. Thomas is the founder, chairman, and managing member of Great Hill Capital. Thomas, always a pleasure. Welcome back.
Thanks for having me, Sean.
I kind of want to get right to it because what happened today, the Fed, what Powell said, was expected up until the point where he said, we don't expect our next move will be a rate hike. And that was certainly good news, welcomed by the markets. Talk more about this decision, what people did expect, and why it was just kind of that kind of day until Powell's comments.
Yeah, it was a big surprise in many regards. What people were worried about would be excessively hawkish talk, which they were kind of signaling coming into the blackout period a couple of weeks ago. So everyone thought there would be no cut, but very few people thought that he would effectively extinguish the idea of a hike, which he did. That was number one. The number two factor that was extremely important and has huge implications in the market is the runoff, or i.e., I like to call the taper of the taper. So they had been letting $95 billion a month of bonds roll off to reduce the balance sheet, $60 billion in treasuries and $35 billion in mortgage-backed securities. They are now going to reduce that by $35 billion, which means when $35 billion of treasuries mature, they're going to now reinvest those proceeds, which means that's additional liquidity in the market. Whereas before, other market participants had to pick up that slack. Now the Fed is going to be back in the market, which means there's a new bid for treasuries. And that's why you saw yields come in just a little bit. And that's why the market got a bit enthusiastic seeing that. At the most optimistic analysts had thought they might reduce it by 30. By going to 35, I think they were trying to send a message to the market saying, we understand how restrictive we've been. We still want to keep rates where they are, but we're gonna throw you a bone here and show you that we recognize the impact on mortgages and people's financing costs.
All right, Thomas, let's talk a bit more about how restrictive the Fed really has been, because at the start of the year, many people, from what I've read, 9 out of 10 analysts, experts in this field, thought there would be 3 rate cuts this year. Now, perhaps 1 in September or November. So what does this signal for the rest of 2024? What should we be looking for?
Well, the other surprise that we saw was he said a weak a weakening in the labor market could warrant a cut. So if in fact we did see a weak jobs report sometime before September, it might bring cuts back on the table. But right now, if you look at the Fed funds futures, I just did before we got on, 54% chance of a cut in September, 67% chance of a cut in November, and an 81% chance of a cut in December. So I do think we're going to get one, possibly two, but that's going to depend on the labor market, and it's going to depend on inflation showing signs of stabilization, which Powell did imply that he could see it happening with owner's equivalent rent. A lot of us have been waiting for owner's equivalent rent to come down. It's been stubborn, but he's in our camp in that he thinks that's going to come down soon.
Okay, let's talk about why Americans are eager for this rate cut. Well, we heard about what John Terrett said. People trying to buy homes right now, very difficult, especially for young people perhaps out to try to purchase their first home. Plus, credit card debt is sky high right now, and it certainly has an effect, one would presume, on just the overall drag, the confidence that things are going to be okay and you can buy big ticket items.
Yeah, there's no question about it. Financing a car, financing a house, first-time home buyers, all these things have impact. But what you're going to now see, even though they haven't done cuts, with the Fed in the market again, reinvesting that $35 billion a month, I do think what we're going to see is bonds are going to stop going down. We know we've had a little bit of counter-trend move. Bonds have gone down recently. Yields have gone up. And I do believe mortgage rates are going to stop going up and may even start to come down now that the Fed is back in the market. So good news is on the way. Cuts might be a little bit further off, but we're going to watch the labor market. You pointed out the PMI was in contraction.
Right.
So there are some points of slowing that could give the Fed cover to maybe go a little earlier. But I think September's still on the table.
You know, we also heard Powell say that, look, he's going to make the cuts when it's appropriate. He's not going to put politics into this. And that's important because obviously September, just before the election. So let's talk about the importance of hitting that 2% target. Right now it's between 3 and 4, and it has been sluggish. It's been stuck there. It's been a long time since we had a reduction.
Yeah, there's no question. They have to continue to talk about 2% because they have to anchor inflation expectations. If people believe inflation is going to go back up, it affects their activity in the present, which means they buy more, which stokes more inflation. So they're going to continue to talk 2%. If we run at 2.7 on their preferred inflation gauge or 3%, it's not the end of the world. They're not going to necessarily hike, but it may delay them cutting. But if we do see some weakness, like you saw with the PMIs, and maybe we start to see some in labor, they could go sooner, and that'll be a positive thing. The sooner they go, the less they're going to have to do, Sean. That's the key message.
Yeah, Thomas, we don't have a lot of time, but I think it's kind of important to talk about the GOP frontrunner Donald Trump saying that if he's elected again, he's going to take a much more hands-on approach moving forward in the Fed. And that raises a lot of concerns for a lot of people. I'd like to get your thoughts on that.
Yeah, the history of the Fed is that it's an independent body that controls the cost of money. I think that's a proven source of stability throughout the decades. I think that needs to continue to be in place. I think with any political election, the name of the game is you don't want one party to have all the power. So as long as there's some checks and balances, that is unlikely to happen. Irrespective of which party gains the executive branch.
Spoken like a true diplomat. Thomas Hayes, thank you so much. We appreciate it.
Thank you.
And we're back. Also want to thank Chibuke Ogu for including me in his article on Reuters this week. And the quote of the week from Warren Buffett: "Don't get caught up with what other people are doing. Being a contrarian isn't the key, but being a crowd follower isn't either. You need to detach yourself emotionally." And it's really interesting. Had some friends go over to China in the past week and kind of update me on the sentiment and the business outlook and the political outlook. And it's interesting because everyone's looking in the rear view mirror, and sentiment is pessimistic. And you go on the ground and you would expect to see something different, where but the fact of the matter is human beings are human beings everywhere, whether they're in China, whether in the US, whether they're elsewhere. And the fact of the matter is it's been in a, sideways chop for a year and a half. Of course they're pessimistic. That's exactly where they need to be before we get the big turns. And we're going to talk about big turns today and this week. It's mind-boggling what we're seeing here, and very exciting. So here's BABA today, by the way. Speaking of China, got up to, looks like it's at here we are at 2 p.m. Eastern time, 11 a.m. out here. It's at around $81.50, up from $68 just a couple of weeks ago, about a week and a half ago. So we'll get into some of that. But I want to draw your attention to what we were covering in our article of the week on March 28th. So just 4 weeks ago, when everyone was in the doldrums, and we pointed to this Hang Seng index and how it's bottomed over the last 30 years, and how this was exactly the same situation in our view. And then we went into explicit detail on this new version of Federal Reserve's Financial Conditions Index, and how every time this had peaked and started to roll over, China took off like a rocket, and that this time would be no different. And sure enough, that's starting to fall into place. And then finally, we spent 2 weeks going through the sentiment chart of Alibaba, and how we were in this period of depression where the bottom had been put in, then you rally, you have these downtrends, and then you get into this depressive mode, which is where we were at the time of this chart. It was trading at $71.34 just 4 weeks ago. And then we also showed another sentiment chart from the Justin Mammoth, where we said we were in aversion. So we had hit the discouragement phase, then we had this wall of worry, now we got up to anxiety, then we rolled back over into aversion. I said we're right here in aversion, and now it looks like we are headed back towards denial, and then we're going to break out into returning confidence. And this continues to repeat over and over. So go back and revisit that, because it can be really helpful. You're going to see this over and over when you're dealing in good quality businesses that are temporarily impaired. Here's a chart. Hong Kong stocks trade at a steep discount to global peers. You can see 8.5, 9 times earnings, versus Tokyo is at 15 times, versus S&P at 20 times. Price is what you pay, value is what you get. And we are interested in value. We had a lot of earnings this week. We're only going to get to one in detail. We'll get to the others over the coming weeks. It seems like they all reported in 1 week. The good news is they all had pleasing outcomes in our view. For some of the impatient people that expect turnarounds to happen in 2 weeks, maybe they didn't get everything they wanted, but we got everything that we wanted ahead of schedule and on time. So here's Stanley Black & Decker, beat on the bottom line, beat on the top line. You can see that right here. But the stock was down a little bit. Let's just take a look here. Yes. And look at their press release, SWK. Okay, so yeah, they sold off a little bit after earnings. Everyone's upset. So what is everyone upset about with Stanley? It's more of the same thing. Again, we just zoom out, and all it's doing is doing what it does. It's putting in its base to recover over time. So what was the issue? The issue was that the consumer was a little bit weak in this. But here's what they did. They delivered on the most important thing, where they're ahead of schedule on their pre-tax run rate savings of $1.5 billion by the end of this year, $2 billion by the end of 2025. Historically, we had covered that's about $10 a share. You put a historic multiple, and that excludes the growth that they're going to see. The revenues, this is what people were upset about, where the revenues were a little light, down 2%, but they beat expectations. This was all expected. Their gross margin, however, was up 740 basis points. So the top line will come back over time. This is a cyclical thing. There was a lot of inventory buildup, as we've covered. There was a lot of projects done in the rearview mirror, and it's catching up. The IRA Inflation Reduction Act money is hitting in terms of construction projects. You'll see that. You'll see the housing reaccelerate now that the Fed is back in the market buying bonds, which we're going to cover later in this call. So this is all in perfect order. They generated, for full year guidance, they're looking at $700 to $800 million of free cash flow. That's all you want to see in a turnaround situation. Stock is down, 60+% off of its COVID highs. They've got $700 million of runway. They're going to cut another, call it $700 million of costs. The construction is going to come back, the Inflation Reduction Act jobs. And what do you need to do all of that as rates come down and home construction reaccelerates? You need tools. They've got the tools. They've got the best tools, from DeWalt to Stanley to Craftsman. You name it, they have it, and they are going to benefit. So the gross margin was huge. Adjusted gross margin, lower inventory destocking costs. So they're getting through the 6 quarters. Remember, they had to work through from the over inventorying during COVID. Net earnings were 0.5% of sales, up 530 basis points. And where is the other issue I wanted to talk about here? Full year guidance, they're expecting adjusted EPS of 350 to 450. So this is all coming together as they'd explained. We'll go into a more detailed explanation in one of our weekly things, but I wanted to just get through a bunch of these. Same thing with Baxter. What happened with Baxter? Baxter is right here again. Baxter beat on the bottom line materially, missed a hair. This might be incorrect numbers here on this. Let me pull up their chart. It looks like they missed a little bit on their top line, but I think that 3.59, what were they expecting? 3.55. So that's actually a beat. That should be in green, not in red. So they beat on the top line and the bottom line. And so what's the problem? Is that if you remember, we bought this in the hole in the fall when everyone was selling off of GLP-1 scares. All the medical device companies were getting flushed, and now they've started to recover, and they're just stalling here just a hair because that's what happens. Nothing goes straight up. But if you zoom out, okay, so it rebounded from 30 to 42. Now it's pulled back to 36. This happens every single recovery. They shoot up, they check back, they shoot up, they check back. And if we look at the data, the revenues were up 2%. Sales were $3.59 billion, up 2%. Earnings exceeded expectations. Guidance was okay. Expecting 288 to 298 per share this year for their guidance. They got the new volume infusion pump. If you remember, that was a concern. It was their stuff outdated. Now they've got the new one approved. So, if you look at $3 a share on a $36 stock trading at 12 times, historically 16 times, and that excludes growth, this thing will re-rate as people start to understand the pro forma going forward. We'll do, again, a detailed thing, but I just want to put these things in perspective because people see these short-term things and they get all sideways and confused. Let's look at Generac. Okay, here's another one that we're going to spend a week on coming forward, but not today. And Generac, GEN. So there's 3 of them, with 2 of them beats on top and bottom. And this one is no different. They beat on the top line, they beat on the bottom line huge, they beat on the top line. Couple key highlights, and then we'll move on here. A lot of earnings this week. Retail sales, residential product sales increased 2%, which is good to see because they had a huge amount of inventory to work through, and rates are still high. Even their commercial and industrial, which was supposed to be weak, because they had such a big year in commercial and industrial last year, was up 2%. And they generated cash from operations of $112 million versus negative $19 million the prior year. Free cash flow was $85 million compared to a loss of $42 million in the first quarter of last year. So look, they're hitting on all cylinders. Gross profit margin up to 35.6 from 30.7. All of these things are happening. So what happens with the stock? It doesn't happen quickly enough for all the basement traders in their pajama traders, and it doesn't break out according to their squiggly lines overnight, and they puke out one of the greatest turnaround stories. So yeah, here's the puke. The smart people are buying more, and this thing's up from like $80. It got up to $140. Now it's $130, and it'll be over $150 before we know it. So not worried about that one. And then finally, so 3 for 3, Amazon. Here's another one we own, beat on the top and bottom line. I don't need to talk more about that. That's all over the headlines with the AI story and everything else great going on with that. Moving along, just see. Oh, 3M. This one has been a monster. They not only beat all expectations, but the stock actually went up, which is an added bonus as far as we're concerned. So remember, we also got the Solventum spin. So this is an adjusted price, but just in the last week, it popped about 10%. Market likes that they normalized their dividend, okay, now that they spun out to Solventum, and their sales were flattish, which was expected. Let me just pull up their earnings here, because they might have been a little light on. No, they beat on the top and bottom line too. So 4 for 4. That's what we like to see. And let's see. Okay, successfully completed the spin of Solventum on April 1st. So for every 4 shares of 3M we now have 1 share of Solventum. We are keeping that business. We finalized legal settlements for public water suppliers and Combat Arms earplugs, which is great. They de-risked it. They normalized the dividend. They cut that, which is great, which is interesting. It rallied on the cut because the market had wanted that to shore up the balance sheet. All of the dividend payers were out of it, dividend investors. Initiated guidance on continuing operations and updates on capital allocation framework. And as we've covered, they got their new CEO, Bill Brown, which is fantastic. And so we can go through this. We've got a lot of earnings stuff to cover over the next few weeks, but I just wanted to get to the high level highlights here because a lot of great stuff happening there. All right, now, a couple charts here from Bank of America. Thanks to my buddy over there. Rail freight carloads continue to rise, pointing to a manufacturing recovery. We're not seeing it in the PMIs yet, but that takes a little while, as you saw in 2009, as you saw in 2020, as you saw in 2003. And then same thing with the inventory cycle is at its trough. A restocking cycle should begin soon. We're not only seeing that in Generac and Stanley Black & Decker and Baxter and Intel, we're going to see it. That's another one that, by the way, we talked about making that a full position again. If you remember last year, we initiated in the mid-20s, around 25 and change. We got out at 48. It went to 51. And then now it's collapsed back down to 30, which means it's $15 below just its legacy business. Forget about the AI story. People need to separate that. We are nearing a computer refresh cycle, not to mention all the data center expansion. So we like it here. We're considering being more aggressively involved beyond just the house's money. If you remember, we took off 2/3 at 48, kept 1/3. We may be getting very interested. Let's leave it at that. Reason for optimism: after a lackluster decade, U.S. productivity is on the upswing. That's what enables us to have wage growth without overall inflation, as long as the Productivity is increasing, and we continue to see that, so that's a positive thing. Tech rally propels emerging market stocks, best week since July, so the money's now moving into emerging markets again. All the factors that we've talked about are starting to play out as anticipated. Emerging market bonds are catching Wall Street's eye. China hints at new growth push as it warns of rising uncertainties. Hong Kong stocks complete their biggest monthly gain since early 2023 as manufacturing report brightens China's growth outlook. That was the PMI, manufacturing activity over there. Then Bank of America, China's recovery as factory activities holds up. So they had some good economic data. Beijing further loosens home buying curbs in non-core areas. You know, like all politicians, they always do the right thing after they've exhausted all other possibilities. China is no different. Goldman says funds likely selling Japan stocks to buy Hong Kong. What was everyone chasing? The new shiny object in Japan. What's changed? Well, what's changed is the BOJ realized they can't have their yen fall to 160. They stepped in the market with $23 billion of intervention earlier in the week. They now have to defend the yen until the Fed starts to ease a little bit, which we're going to talk about how they did ease. We did talk a little bit about with Sean, and that money's going to move out of the shiny object called Japan and into China over the next 18 months. No one believes that. Why? Because everyone's been chasing Japan after it's doubled, and now they're going to get their heads handed to them, or at least on a relative value basis, see China start to appreciate much more. Not consensus, but it's playing out. China stock rebound driven by earnings growth. Japan equities also were a haven for people getting out of China, number one, and number two, getting that exposure when they didn't want China. So money getting out of China, and managers who wanted Asian exposure but didn't feel comfortable in China, they all crowded into the same boat. Now everyone is bailing, and we're going to see more of that. China stock rebound, not just driven by flows and currencies, but also driven by earnings growth, and we're beginning to see that. China factory activity holds up, signaling recovery has legs. If you're listening on this podcast, this must sound strange to you because I'm going through page by page, Wall Street Journal, Bloomberg, South China Morning Post. I'm going through all of these. It's a better experience if you can watch it, but if you can listen, we're grateful to have you as listeners as well. Japan likely spent about $23 billion on the latest yuan intervention. We covered that. An influx of Chinese tourists is coming to a country near you. Chinese stocks see the longest foreign buying streak in a year. Even 4 weeks ago, you wouldn't imagine these headlines would exist. China's property slump. Beijing ends curbs on multiple home ownership in outer areas of city to stimulate buying. We won't stimulate property. Oh, yes, you will. It's amazing what happens when you have, 20% youth unemployment. You have capital fleeing to your enemy in Japan, and you can't figure out your, from your elbow. All of a sudden, you do an about face, and the elites are restless. Not just the 20-year-olds, it's the elites that are not happy. And for anyone who knows how that country works, they'll only remain unhappy for so long because I forget which Chinese leader said it, but it was to be rich is glorious. The elites still buy into that philosophy, and they're not going to let anyone impinge on their ability to do so. China property new stimulus is on the way as Politburo pledges to cut housing inventory, says analysts. MGM stock rises as Wall Street praises earnings. There's momentum in Macau. Who's in Macau? The Chinese. What does that mean? That the game is back on. Hong Kong stocks march into bull market as global money returns. So this was the multiples we talked about. These are flows. You can go on to our daily reads and see those. 3M is resetting its dividend, why its stock is soaring. This article from Al Root over at Barron's. You can go ahead and read through that. Google sales accelerate. Oh, we forgot to cover that one, which is another one that beat on the top and bottom line that we own. We've had that one for a long time, since fall of October 2022 and March 2023. Cloud business holds up amid costly AI push. Intel CEO, this one appeared to S the bed during earnings. That just created an opportunity to get back involved. And we think we're going to take advantage of that. Intel CEO confident in its AI future after posting soft guidance. I really don't care about his AI future. That's the free option. What I'll do is play this thing all day long back to 45.50, which is the value of its legacy business that's getting ready for a cycle refresh. And then if I get another 30 to 50 bucks on AI, I'll take it and his new foundries. 3M stock surges toward a 14-month high after profit sales beat expectations. So look, guys, all these things that when we came out and said were going to happen are starting to all come together at the exact same time. And what I also said is when everything looked most despondent, when it happens all at once. And one of the factors that's going to be fuel to the fire is what Chair Powell announced yesterday. Alphabet closes above $2 trillion market cap for the first time. Generac Holdings surpasses revenue estimates. Amazon Q1 top estimates as cloud demand rises, AI wave higher. You can just replace Amazon for Alibaba in coming quarters. You're going to start to see the exact same story as cloud demand rides, AI wave higher. It's going to be a bigger story than AWS. I know no one can see that now, but if you can't see, borrow my glasses and we'll get you there. Air conditioning and AI are demanding more of the world's power. Renewables can't keep up. Well, guess what can? Natural gas. We love Comstack all day long. That thing's starting to come out of the doldrums as well. Reuters, don't know what, oh, here we go. PayPal. What are we trying to look at here? I don't know. This overhang thing is in the way. Anyway, we'll cover enough of PayPal in the article of the week. Okay. Oh, this is interesting. Cooper Standard named a supplier of the year by General Motors, so that's a good thing to see. Borg Warner raises full year 2024 adjusted profit outlook. They're an auto parts supplier, a little different business obviously than Cooper Standard, but Cooper Standard reports on the 7th, and based on what we saw from GM and Ford and some of these other auto parts suppliers, we feel pretty confident about that. One earnings report doesn't really matter in the scheme of what we're looking for this over the next couple of years, but things pointing in the right direction once again. Article of the week is Powell's Let There Be Light stock market and sentiment results. So there's a picture of Powell from Reddit. The pajama traders put this together. I had to white out one of some of the language on his quote unquote Bible there. But anyway, Chair Powell came to play yesterday and the market liked it. Is the bottom in the short term 3 to 8% pullback we started calling for in Q1 on our podcast VideoCast? We don't know, but what we can tell you is that our last hedge, the semis put spread, came off on Wednesday on the back of AMD collapsing after earnings. They collapsed on Tuesday night after hours. Stock was down like 10 or 15% in the morning, and we said we're going to take the money and run. So we did take the money and run. Even if we kept a few shekels on the table, we still came out at 2.2 to 2.4x. The only publicly disclosed hedge still on, which is much longer dated, is the TLT call spread, which is long bonds, and that has the highest expected value. So we're going to keep that one on for a while, and we're pretty excited and think that that is just beginning. With all the hedging and tactical shorts in the past couple of months, at the end of the day, quote, quick wins are nice, but not the core of what we do. We buy high quality businesses with moats when they are temporarily impaired on the operating table, but leaving the hospital walking on their feet versus lying on their backs. And what we're seeing this week alone with all of the double beats is that they're not just walking out of the hospital after getting off the operating table. They're starting to jog, and very soon they will be running, and soon thereafter they will be doing marathons. And then everyone will be cheering at the finish line, and we will be laying off the stock. So we buy high quality. Okay, we got that. That is our knitting. But I would say this campaign was successful and allowed us to stay 98% long through the volatility. We'll let the TLT long bond call spread run for a while as they have the highest expected value. If the others flush further, which is better than a coin flip chance, the market could go lower. so be it. But I'm not going to get in the way of an additional $35 billion a month of new liquidity coming into the market over the intermediate term. The moves we made served their purpose, and now we're going to redeploy that cash. So hot off the plane, we went through the Caleb's interview. Here were my notes ahead of the segment. What was expected was no cut. What was not expected was the option of a hike would be taken off the table. And more than that was the magnitude of the taper. I spent literally the last 3.5 to 4 weeks of notes and calls saying, guys, everyone's focused on cuts. Stop focusing on cuts. They're not going to cut this month. Focus on what they're going to do with quantitative tightening, tapering the taper. I said it on the Clayman Countdown. I said it on many public appearances. Everyone looked at me like, what does that even mean? What it means is before they were letting the bonds roll off, which means they had to be absorbed by another institution or another buyer in the market. What does that mean? It sopped up 30, in this case, it's going to be $35 billion of buying power that could have gone to equities, had to come in to bonds. Now you're going to have 35 billion that they're going to be in the market replacing the proceeds. So rather than other people having to step in at 35 billion a month, the Fed is going to be stepping in $35 billion a month to replace those roll-offs, which means that 35 billion is going to be pushed further out on the risk curve into equities. This is constructive. This also means there's a natural buyer in the market for bonds, which means rates are going to start to compress, stop going up. Bonds are going to start to go up. They're going to start to get bid as they become a player in the market. So this is a big deal. The other thing to keep in mind is their MBS roll-off is now going to be reinvested into treasuries moving forward. So they're going to create a big bid in treasuries, hence the TLT, longer dated call spread play, which has an EV of something like 8x, which would be pretty damn exciting. Okay. We covered the chances of hikes. PayPal is my pal. So you can see here, traded down into the fall of last year, down to $50, shot up to $70, and now it's retesting. This could be an inverse head and shoulders. It's all nonsense anyway, but this is what bottoming processes look like. We'll see here, there's a lot of buying volume around 62.50 if it holds that level before resuming higher. I think it's got the legs too, and based on what I read and observed in the earnings results, this thing is just getting started, and I'm super happy we've got a very nicely sized position in this that we've been talking about on the podcast VideoCast. And this is a long-term play, as are all of our long-term plays. Again, none of this is investing advice. Do talk with your financial advisor and do your own homework before doing anything. We deal exclusively with accredited investors that have a different risk tolerance. To see the terms, go to hedgefundtips.com at the top. Click on terms. We'll also play our famous disclaimer at the end of the podcast VideoCast. If you're listening, go to the YouTube version or go to the version on hedgefundtips.com. And we have a new music jingle to go along with it this week. I think you'll be very pleased. We're going to move from a rap theme to a country-ish theme, and I think you'll like it as much as I do. So each week we try to cover the earnings of one or more companies that we've discussed in previous podcast VideoCasts. PayPal reported earnings on Tuesday, and they were very good. New CEO Alex Chriss is executing on his plan to, quote, shock the world over time, just like he did at Intuit. I'm saying the shock the world in jest because if you remember, he did that 15-minute recorded thing in January and it fell flat. The joke is that everything he said he's going to do is already starting to happen. It just didn't turn the stock around or shock the world in 5 days. It's going to take a half a year to a year to really gain traction. But the fact that they did it in the first quarter is awesome. Revenues were up 9%. EPS was up 18%. Non-GAAP was up 27%. And the continued focus on high quality, profitable growth is at the forefront. Transaction margin dollars increased 4%. Operating income up 17%. Operating margins expanded 98 basis points to 15.2%. And operating margin non-GAAP it also increased 84 basis points to 18.2%. GAAP EPS up 18%. Non-GAAP up 27%. And we're going to talk a little bit about what they're doing in terms of the new methodology, which is very shareholder friendly. And I'm really pleased to see that they're thinking about that, respecting equity with this. They're moving from all this stock-based comp to more cash comp, pay for performance, and they're going to break out stock-based compensation expense. So it's transparent, and unlike most companies that they just give away the whole cookie jar and then they buy back stock to offset it, thinking that investors won't notice it, but they're basically taking your wealth to give it to them and calling it a wash when it's not a wash, because they've still taken the owner's wealth and given it to non-owners to make them owners and give us smaller pieces of the pie. So we'll talk a little bit about that. Total payment volume increased 14% for the quarter, which is huge. Payment transactions increased 11%. Payment transactions per active account on a trailing 12-month basis increased 13%. Now, active accounts decreased 1% to 427 million. But if you remember, last two quarters, we talked about they're firing unprofitable. Remember, profitable growth is what he's focused on. So those Latin American customers that were losing money, they just fire them. They turn off their accounts. And this is part of that process. On a sequential basis, active accounts increased 0.4%. So from last quarter to this quarter, up 2 million accounts. So they're bringing on profitable growth accounts. Cash flow from operations, 1.9 billion for the quarter. Free cash flow, 1.8 billion. Okay, that's a huge quarter. On a trailing 12-month basis, cash flow from operations, 5.6. Free cash flow, $5 billion. And people are wondering, is the turnaround going to work? When you have that kind of free cash flow trading at these multiples with this type of leadership, it's not a question of if, it's a question of when, in our humble opinion. Adjusted free cash flow, we covered that. On a trailing 12-month basis, adjusted free cash flow is 5.4. They've got 17.7 billion of cash and cash equivalents on the balance sheet. I wonder if they're going to make it, ladies and gentlemen. I don't know. Oh, but they have $11 billion debt, which they could pay off tomorrow, by the way, with their cash just sitting on the balance sheet. Returned 1.5 billion to stockholders by repurchasing 25 million shares. And by the way, over the last 12 months, they bought 81 million shares at 5.1 billion. This is what you want to see from a company. Very few managers do it in practice, buy their stock in the hole. That's what you want to see them do. Most of these managers, they buy it after it's already doubled or tripled, and they get caught up in the hype when they should be selling stock and creating equity because they're probably at the end of the cycle. So they're doing exactly what you want to see them do. But just look on every metric, the year-on-year growth is staggering. Payment volume up 14%. GAAP net revenues 9%. Transaction margin dollars 4%. Operating income up 17%. Operating margin up 98 basis points. Effective tax rate, that's net income up 12%. Earnings per diluted share up 18%. Net cash provided by operating activities up 64%, ladies and gentlemen. That's all GAAP. Non-GAAP are in the same ballpark. So there you go. Some other key highlights here. Let's see, where are we on time? Okay, we've got a lot of Ask Me Anything questions. You can see the free cash flow. So they delivered Q1 results ahead of guidance. They're accelerating the speed of execution. They're including stock-based compensation in non-GAAP results, aligning employee incentive plan metrics to profitable growth and shareholder value creation. In other words, if we don't win, they don't win. And that's what you want to see from new sheriff in town, Alex Chris. Priorities focused for execution in fiscal year 24. Accelerate our branded checkout business, improve overall profitability, including higher growth, unlock the power of data to create more value for customers. And they talk in detail about how they're doing it with their fast lane checkout, which is getting 80% conversion, unparalleled in the business. So as we go through some of these key things here, why are they modifying their non-GAAP results to include the impact of stock-based compensation expense and related employer payroll issues? This modification is intended to improve transparency and discipline, as stock-based compensation expense is an integral part of our cost structure, and to enhance overall investor understanding of our operating performance, which is good. So they got, let's see here. They had 10% revenue growth on a currency neutral basis, or $404 billion in total payment volume for the quarter. Our results are stronger than we expected earlier in the year. Remember our last article last quarter when I said sandbagger in chief because he put out low guidance? Well, it took them 3 months to already raise the guidance. What do you know? Shocker. Which is okay. We expect full year EPS to grow mid to high single digits, which is code for low double digits, which I said was going to happen last quarter, which is partially driven by our better than expected start to the year. We're shocked how good we're doing. I'm not, by the way. Thanks for your performance. All right, large enterprises, low double digit lift in guest checkout conversion, which is good because then they can start to charge the merchants more because of all the value add services. There's a ton in here. We're not going to go through all of it right now because we got to keep this under an hour. The key pillar in our post-purchase. Okay, 21. They're talking about the Venmo debit card, all these initiatives for growth. Okay, in addition to our annual incentive plan shifting to cash payment from stock, this is what I've been pushing Alibaba should be doing. They give away way too much stock. Just pay them for performance, give them cash, don't give them pieces of the stock. Or obscene amount of pieces of the stock. Give them some. You want them to be aligned as owners, but not giving away the entire barn. So I've also better aligned our incentive programs to performance, particularly focusing on transaction margin and non-GAAP operating income growth. We will continue to focus on pay-for-performance culture that appropriately aligns with results. This is a huge shift from what happened under the last leadership, where it just became complacent and fat and happy and give away all the stock for no performance and screw the shareholders. So that's over, and the new sheriff is delivering. So we are live with a handful of early partners. He's talking about Fastlane. Just remember, we are now enabling 80% conversion rate for returning users through our guest checkout flow. We're actually seeing unrecognized users. So these are non-PayPal users opting into a Fastlane at a 40% rate. Checkout conversion rate, 60% of the market. Okay, so we went through all that. Sentiment is fearful, not yet extreme. Actually, let's pull up the AAII sentiment survey results for today. 38%. So, again, these are kind of neutral. It didn't get to fully flushed, so we could have another leg lower, but there were enough stocks. As I said, if you remember, there were about 5 stocks. Last week I said the market's probably going lower, but these stocks are at levels I want to buy. And that's what we want to be doing in terms of delivering value. Is we don't have to be perfect about the market. What we have to be is perfect about price is what we pay and value is what we get relative to what we would pay as a private buyer to take the entire business private. And if the public markets are offering a price that if I presented it to the board, they would have me escorted out of the building because it was an insulting offer, that's when I want to be a buyer. And there are many businesses trading at prices right now that if I went to the board with financing from JP Morgan and offered to take the entire company private at the public market quotation or even 30% above, they would call security to have me removed from the building because it would be the most insulting offer I could possibly give them. And yet I can buy it at 20 or 30% lower in the public markets right now. And those are the businesses that we are buying and leaning into, and we love the opportunities that have been served up. Earnings, communication services earnings, top 30 weights estimates in the last 60 days. Communication services was revised up for this year by 1.44%. down 0.8% for next year. Tech earnings have been revised up for both this year, 0.79%, and next year, 0.92%. Earnings are coming in strong. Economic data has largely been coming in pretty good, although there's enough soft points that the Fed could start to lean on. The key is going to be the jobs report tomorrow is going to tell the whole story. Because the minute they get a weak jobs report, they can do their first cut. I don't know if it will be this month or not, but that's what they're looking for, because their preferred inflation metric is at 2.7, which is right in the ballpark. So they do need something to give them cover to do that, and most likely it appears will be September or December. The earlier they go, the less they'll have to do. This week is what I need, not next week. Okay. That's Chinese manufacturing PMI was in expansion and beat expectations. Let's take a look here. I'm looking for U.S. data. House price index, not important. Chicago PMI came in really low, 37.9. Consumer confidence came in much lower than expected. So there's enough here showing enough slowing that we may be able to get in one, maybe even as many as 2 cuts this year. The key is that they're winding down the taper, which is going to be the big thing for yields and mortgage rates to stop going up and the game to be back on. Construction spending. So construction spending was a little bit down. That's, you see in the companies like the Stanley Black & Decker, et cetera. That will change as rates stop going up. I think people are at the point where they would like lower mortgage, but as long as it stops going up and starts to come in a little bit, they've been waiting so long to act, they're going to go ahead and act. And tomorrow's the big jobs report. So let's get to the questions of the week. I think I missed a couple questions last week. The pages fell on the floor or whatever it was. Tim Cowan was asking what your view is on SUP Superior. I know you own CPS. Highest operational Superior is interesting also. I looked at it. It's okay, but I prefer Cooper Standard. Greg Owens, thoughts on Warner Brothers Discovery. We've covered this one multiple times. It's not one that I get excited about, but I could definitely see taking it as a trade, but we're not. So that tells you everything you need to know about how I think about it. I think we're getting to the point where enough of the competition is going to be flushed out. There'll be 3 or 4 major streamers, and then they'll be able to raise prices, run ads, etc. And Warner Brothers Discovery should have a seat at the table in that context, in which case it is cheap. But we've already looked at the financials 100 times, so we're going to skip that one, and you can go back to previous podcasts. Okay, let's take a look here. No, that's spam. Working off a laptop here. Okay, Jordan Smith asked about Bristol Myers. I've looked at this one. I haven't done anything. I think you're right. I think you can. They sold off after earnings. I think it's going to be fine. Was logged in. Okay. By the way, the formal podcast is over. We're starting the Ask Me Anything questions. So if you want to stick around, please do. A lot of people give great feedback and find this to be very helpful. So I think we might even have. So here's Warner Brothers. I think you could take it for a trade. Revenues have been flattish. Their debt is enormous. But if I recall, their free cash flow is okay. Yeah, I mean, you could take a punt. We're not doing anything with that one, but I think there's something to be said there. Bristol Myers, their free cash flow has been flat for 4 straight years. Same thing with earnings, more or less. It's trading down towards the bottom of their range. I just think there are better things to do, but I could definitely see holding Bristol Myers for the long term down. It's down a third. I mean, in the low, it is in the low 40s, but towards a 40 handle, I'd probably take a punt. This one just doesn't excite me. I gotta say. I mean, if I can't get a double over 2 or 3 years, I'm not really going to risk capital, so it doesn't really fall in my bucket. But I think your framework is correct, Jordan, and I think if you have a long-term view, you'll be okay with that one. Daniel D asks a question. What is your short-term thoughts on Amazon, Meta, Tesla, Apple? Thank you. I think that's not really helpful for anyone because trading in and out of these businesses, you're just coin flipping, guessing. I mean, they're all good businesses over time. Apple, for me, the multiple expanded so much, and I think the growth is slowing. For me, that doesn't add up. So for me, it's not interesting. Meta's probably got to retrace some and consolidate for a while because they've got a big AI spend. Tesla, for me, I've never gone long or short Tesla and probably never will. I think there's too much key man risk, and I'll just leave it at that. I'm not going to elaborate on that. But and Amazon we own, so I don't know what it's going to do over the next 3 months, but over the next few years, it's going to be higher. And fact is, we bought it in the hole in fall of 2023, so we've got a huge margin of safety. It could literally correct 60%, and we'd still be profitable. So we'll leave it at that. Doug, avid follower of your insights for the last few months. Thank you very much. I have a small amount of capital that I'm looking to invest wisely. Was wondering the positions currently, a couple of you should consider. Doug, based on the amount of money that you have set aside, and it's a pretty small amount, number one, you should always start with a financial advisor. But I think at this point, you want to be in index funds for that small amount of money. I don't know your age and I don't know your situation and your risk parameters, so I would definitely talk with a financial advisor before you do anything. But the amount of small money that you have, what I see is that people that have small accounts, they try to get rich too fast and they blow up their account. So they'll say, oh, well, if there's 8 ideas and I just put 100% in my highest conviction idea, then I could, rather than gaining 30 or 40% this year, I could gain 130%. And they wind up putting it all in the one that doesn't work, which is why you want, we run a concentrated portfolio of 8 to 12 stocks for clients. So for you, you're so early in the game. I would just be trying to compound money over the long term until you learn and use this time to educate yourself. Talk to a financial advisor, set up a long-term passive plan, and then as you build wealth, then you take a couple $1 million and you go with an active manager or start to invest in individual companies yourself, and you can really grow faster. But that's not what I would be doing at your stage, because at your stage, your biggest risk is that you take the wrong risk. As you get more and more wealth, you can take punts with small percentages, which are a lot of money. When you get 8 and 10x, it's material amounts. But if you do that when the amounts are small, you just kind of treading water in place. What do you think about CVS? Thanks for your great podcast. I don't love these at all. Any of the drugstores, let's see. I mean, so it's down to 50. This will probably work. I mean, Again, I don't love this. I think there's going to be more pain. Let's look at it again in the mid or low 40s if we see it again. I mean, obviously the multiple's low. Let's see. Sales are flat. Cash flow's flat. You know, that's the thing that you have to be focused on as a value investor. It's like, if you're getting no earnings growth and it's not a cyclical trough due to some exogenous event, then either the multiple has to be really low or you have to be clear on what's going to unlock the value. Are they going to break up the parts? Are they going to get new management? Are they going to, what are they going to do? And in CVS, that's not clear to me. And honestly, the discount is not big enough for me to start to do the work. I mean, this thing is down 45% and it's a low quality business as far as I'm concerned. So I would start to do the work when I have a clear chance to make, you know, double to double and a half over 3 to 5 years. And I don't see it yet. We're getting closer, but the threats are coming from all different areas, whether it's Amazon, whether it's direct to consumer on the drug front. The cigarette franchise is obviously dying. So I just think there are higher and better uses. Just because they fall a lot quickly doesn't mean they're great investments. That said, if it gets cheaper, at some point you got to take a look. Relative to the quality of business it is and how far it's fallen, I don't think the risk reward is worth me doing material amounts of work yet. And I'm perfectly fine with errors of omission, missing opportunities versus errors of commission. Aaron Oda asks about Starbucks. This one's really interesting. You know, it's kind of a play on the recovery in China, except for the fact that they're getting outcompeted in China by the Luckin's and by other coffee companies, McDonald's, etc. I saw the CEO on CNBC yesterday morning, and I thought it was atrocious. This is not a guy I would want to invest my capital with. So what I would like to see happen for me to get interested from an aggressive long-term position, I'd like to see this thing drop to $50, because at $50, the board is going to throw them out, and I'm going to get someone that can turn it around and double my money in 2 to 3 years. Right now, with the stock down, 25, 30% off of its highs, and this guy running the shop with comp store sales down 3% year on year and not pre-announcing, I just, my spidey sense says hard pass on this guy. This is not, as great of a business as Starbucks is, and he probably can't destroy it. He seems to be working overtime to try. And I'll leave that to someone else to participate in. That doesn't mean I don't think it'll bounce and it could be a good trade for a couple of months or a few months, but I think it's got to fall further for him to get replaced, and I think that's going to take a while because he's relatively new. So for me, it's an error of omission. I could be wrong, and he'll just get swept up by the China recovery and everything will be back off to the races. But, seeing the weakness in the U.S., how do you screw that up? Well, he's figured out a way, and I don't want to spend time waiting for him to figure out how to reverse the errors. So sounds like his problems are just beginning versus turning the corner. Okay. All right, bear with me. Oh, by the way, first off, I want to thank Presley for years of great service running the videos that you see on TikTok and Instagram and LinkedIn. He's done an incredible job, so much so that he's now graduating on to do amazing things in what he loves to do, which is producing videos, commercials, high-end stuff. It wouldn't shock me if the guy becomes a movie producer, and really super guy, and so happy to have had him. I also want to thank all the people who applied. I put out a short video on Instagram and LinkedIn for a video editor that he could help me transition over, and we got like 7 unbelievable applicants. Want to welcome Max on board. And for those of you who applied and it didn't click, we'll keep you in mind for future projects and positions. So I appreciate your quick responses, your amazing backgrounds and talents, and we'll leave it at that. So Marcelo, we covered that. Ooh, okay. Yeah, so Vojislav is asking me as a follow-up to the HelloFresh and Factor, which we covered last week, if I'd done any more work. No, it's just not a business I like. So whether I like the food or not is immaterial. I just don't think I like the business. So irrespective of the numbers being amazing, I appreciate that. I've just seen enough cycles where you get a spidey sense, and I'm perfectly comfortable with an error of omission versus commission. I still eat their food, and I liked it last week, so I didn't think about canceling last week. Maybe next week I'll think about canceling. But if they ever opened up a good poke place in town, I would definitely cancel HelloFresh. The problem is HelloFresh comes to me, it's good, especially their gourmet offering, not HelloFresh, what the hell is it called? Factor is good, it's quick, but that's more of a commentary on my town in Connecticut having good, quick stuff that I can get versus Factor being, the answer. But their numbers are good. I just don't like the business. I like the product. I don't like the business. Okay, that's another applicant for the video. Mark, that's for the video. Sagar is for the video. Deepak is for the videos. Max. Paul Hauk, what are your thoughts on U.S. national debt, and does it affect your investing strategy? Yeah, too much of it. They have to inflate it away, and our portfolio is positioned for the dollar to go weaker over time, which means a big exposure to emerging markets in China. We also think small caps are going to outperform, and other groups that haven't participated as much, like REITs, like dividend payers, et cetera, all the stuff that we have discussed. Manny, is there any significance to high institutional ownership? Are they the smart money or just as dumb as the rest of us? Is this a meaningful metric or just noise? It's just noise. I mean, you want to see some institutional sponsorship over time, but the stock you're referencing is a mid-cap, small to mid-cap, and that institutional sponsorship will grow over time as they get bigger and people can put more money to work. So I wouldn't pay too much attention to it. More is better, but I wouldn't make any investment decisions on that basis. And the final one here is what is your perception of which sector is getting hammered across the board most currently? It seems to me pretty much anything that has something to do with renewable energy. I keep looking for renewable energy plays because it is getting hammered. The problem is most of them have terrible balance sheets. Of course, these things suffer short term with high rates leading to customers postpone big balance. Solar, wind, most renewable energy drops like a rock. Generac is all like that. Any other ideas on that front? No, I've looked at a bunch of the solar companies. I don't like any of the balance sheets yet. I continue to look in the renewable space. And to your point, Generac is a great play on that, as is Comstock. So I'm kind of covered on those. And I'll leave it at that. So with that said, I want to thank everyone for tuning in. We'll be back next week, back in Connecticut and New York. Same time, same place. In the meantime, make it a great one. Bye for now. Thanks for tuning in.